Welcome to On My Way to Wealth, the podcast where busy Gen Xers can learn financial tips as they navigate life on their way to wealth. And now, please join your host, Luis Rosa.
Hello, and welcome to another episode of On My Way to Wealth. My name is Luis, and I'm your host. Today, I'd like to talk to you about rental properties and how they impact your taxes. This is a common question that I get very often from clients and prospects. So I wanted to give you a 30,000 feet view, I guess how they say, very high level, basically. This could get complicated, but I feel like I can give you just enough so that you have at least some basic understanding, know what questions to ask, and what to look out for before you get into it. So how does this all work? You buy a rental property. Well, now you're going to have rental income, hopefully. And you also have some expenses that you can then deduct from that rental income in order to arrive at whether or not you have a profit or a loss. So just want to briefly get into it and tell you a little bit about how it works. So when you buy a rental property, you then have to file a Schedule E on your tax return. So basically, you still file your regular personal tax return just like you do all the time, but now you're going to have an additional schedule. It's called a Schedule E. And in that schedule, you're going to list the property address, and then you're going to break down the income for that property, and then also list the expenses that you had for that property. And ultimately, at the very bottom, then you're going to have either a profit or a loss. And we're going to talk about whether or not you can take advantage of that loss, if you have to pay taxes, if you don't, et cetera. So let me give you a little bit of briefing on that. So what are some of the things that you can deduct? One thing that you can deduct that you would list out on your Schedule E is your mortgage interest. So let's say if you financed the house, you borrowed from a bank, you're paying back that loan. At the end of the year, you get a tax form that shows the amount of interest that you paid during the year. You cannot deduct the principal amount of the loan, only the interest that you paid on that mortgage. But typically, you'll get a 1098 form from the mortgage lender showing you how much you paid for interest. So then you would list that as an expense. That same form, if you pay your property taxes via your mortgage, might also show you how much you paid in property taxes for the year on the property, which you can also use as an expense as well on your Schedule E. So now we have mortgage interest, you have property taxes. If you have insurance, for example, which hopefully you do, you insure the property, you can deduct that as an expense. One really big one, and this is one that a lot of people don't necessarily calculate properly because they might not be aware of the rules, is depreciation. When you buy a piece of property, in your mind, you're hoping that in addition to any rental income, you're hoping that that property appreciates over time, and very likely would over time, right? Which is great. Now, from a tax perspective, even if the property is going up in value, you actually get to write off an amount of depreciation on the house, which really helps out when it comes to deducting expenses from your rental income. The way the depreciation works typically is on a residence that is not commercial, just a residential rental property. You basically take whatever the dwelling is worth and divide it by 27 and a half years. And I say dwelling because you cannot deduct any depreciation for the land because the land does not depreciate. So before you place a property as a rental, you want to make sure that you have an appraisal of the property and that appraisal gives you a breakdown of what the land is worth separately from the dwelling itself, because you cannot depreciate the entire thing. So just to give you an example, if you bought a $300,000 piece of property, you can't just take $300,000 and divide by 27 and a half, because then you'll be depreciating too much and getting much more of a tax benefit than you should, and that can cause problems down the line. So in this example, let's say that you did have a property that was worth $300,000 and the land was worth $100,000. Well, the $200,000 difference, which is the dwelling itself, you get to divide that by 27 and a half years. This is the IRS rule. So you would have a $7,272 per year depreciation number. The first year might not be exact because you might not have placed it in service January 1st, might have been middle of the year, but typically any tax software that you're using, or obviously if you're working with a CPA or enrolled agent, they'll do the calculation for you, prorated based on how long it was rented when you placed it in service. But in essence, you get to then take that 27 and a half year mark, you take the dwelling value, divide that by 27 and a half, and then you get to take that figure as a part of your expenses for that property. So you already list your mortgage, interest, property taxes, homeowners insurance, and then you list out your depreciation. And that could be a big number depending on how much that property is worth. Another thing that you can do is deduct the repairs as well. Now, here we have to be careful because there are a lot of times where somebody misclassifies what the IRS considers a capital improvement as a repair. So when you contrast it to a primary residence, if you have a primary residence that you live in, you do not rent it, and you fix your bathroom, you paint it, maybe you replace something on your deck, et cetera, none of that is tax deductible in that year. Some of that stuff, what you could do is basically just add it to your purchase price. And eventually when you sell, you will determine whether or not you had a profit or a loss. And on primary residences, if you live 2 out of the past 5 years in the property as a primary residence, if you're a married filing joint couple, you can have up to $500,000 in profit that is non-taxable on the primary residence. And then on the rental, there is no such thing, but you do get to deduct the repairs every single year, unlike primary residences. And even things like maybe if you're doing some work around the house, something that's simple, like you just like replace the door, things of that sort, you actually get to take those repairs. Something broke, property damage, things like that. Sometimes like maybe a tenant moved out, you got to get in there, you got to do certain things to the place before you rent it. Those things like that, you get to deduct the year of whatever repairs you had. So again, you would just list that out as an expense on your Schedule E. Now, let me mention some of the big items that sometimes people misclassify that really should be amortized over the remaining years of that property. Things like sprinkler systems, a new roof. So if you spend $10,000 on a roof on a rental property, you can't just take that $10,000 and list it as a repair and then create that loss for yourself, because that's one of the items that has to be amortized and depreciated over time. So whenever you have like a really big item like that, a roof, security system, heating, ventilation, water heaters, flooring, insulation, big things like that, definitely be on the lookout for the fact that this might be falling under the category of a capital improvement, which then has to be depreciated, not taken all in one shot that year. That's something that you definitely want to keep in mind so you don't get in trouble with the IRS. Now, what other expenses can you deduct? These could be things like advertising your rental. So sometimes you have to put it an ad somewhere for when you have a vacancy. If you happen to pay for some utilities that are not being charged to your tenant, you can charge those. If you happen to, let's say you have a property that's not too close to you and you use a property manager and they charge you a management fee, you can deduct that as well. Some people have to travel to visit their homes. So you can deduct, you can either do expenses or mileage for the standard mileage. And also, I often get this question. I say, what if you quote unquote lose rent? Basically, if you have uncollected rent, most people are probably what they call a cash basis taxpayer. So meaning that you declare your income the year earned and deduct your expenses the year expended. So in that case, if you have lost income because your income was vacant, then that's really not a deduction. So, if you rent your property for $1,500 a month and you go 3 months without collecting rent, whether because it was a vacancy or your tenant didn't pay you, then you can't say to the IRS, listen, I normally collect $1,500 a month, but I didn't because my tenant didn't pay me. I'm going to take this $4,500 loss. That's not how it works. the way it works is basically you would just basically list your expenses. So say, here's the rent I did collect, and here's the mortgage interest I paid. Here's the property taxes I paid. Here's the insurance I paid. Here's the management fees I paid. Here are the repairs, utilities, and so on and so forth, and your depreciation, of course. Then at the bottom, after you're done subtracting your expenses from whatever income you did receive, then you're going to end up either with a profit or a loss. If you have a profit, whatever that profit is, then you pay taxes on that money. So you're not paying taxes necessarily on the income that you receive, because you have to net it out and subtract all the expenses. So a lot of people always ask me that question, like, do I have to pay taxes on my rental income? The answer is possibly, very likely, depending on how much expenses you have. But the good news is that you're not paying taxes on the gross income you receive. It's really on the net amount after you subtract all these expenses. Now, because of things like mortgage interest, taxes, depreciation, and all the other things combined, sometimes they end up being more than the actual rental income that you receive, which then turns out that you have a rental loss. And it's possible that in reality, you did not have a loss. So your property could be cash flow positive, but on your taxes, you could have a loss. A lot of the times, depreciation is the one item that helps you put over that hump where you end up with an actual loss on paper because of depreciation. So what happens then? Can you claim that loss? And the answer is maybe, as you expected, right? Because not everything is a yes or no answer necessarily when it comes to taxes. So here's how that works. If you have a loss and you have been considered to actively participate in your property, and that means that you own more than 10% of it, and also you had a say into the tenants, the management of the property. So even if you have somebody that manages the property for you, you can still be considered to have actively participated. So something you definitely want to talk to your tax professional about. But let's say you meet those guidelines. Well, there is an IRS rule that lets you deduct up to $25,000 in losses. This is considered a passive loss. So if your modified adjusted gross income is $100,000 or less, you can deduct the full rental loss up to $25,000 limit. If you're married, filing separate, that gets divided in half. Your income has to be no more than $50,000, and you can only write off up to $12,500. So if you're married joint, you can do the full $100,000 income limit, right? So you can deduct the full $25,000, and that could be something that is really good because it can actually be used to deduct some of your other income that you had, in any income, not just other passive income. That could be income from a job or something like that, or income that you had from selling stocks or whatever. So this is a great planning opportunity as well, so that you can know, okay, speak to your accountant and say, all right, you know what, this year I'm going to have a loss on my property. Maybe it's time for me to sell this appreciated asset I had, whether it's stocks or whatever, to kind of help you offset, right? So this provides for a great planning opportunity. Now, what happens if you had losses and you didn't qualify because you made too much money? There's a phase out between $100,000 and $150,000 where you get to deduct a part of those losses. After $150,000, then it phases out completely, and now you have what's called an unallowed loss. Now, the good news is that is not lost forever. However, it gets carried forward indefinitely to future years. So if you happen to find yourself in a year where you didn't have as much income, you can take advantage of those accumulated losses that you've had. And also when you finally do away with the property, once you sell it and you have all those accumulated losses, you can take them then. So that is also the good news. But I wanted to bring this up because sometimes people might get into a property thinking they're going to have all these great tax benefits. And sometimes you don't necessarily have benefits the year off. Sometimes your best scenario might be that on paper, you have a loss that you can't deduct that year. So it doesn't impact the taxes that particular year. It's just something that for the future might benefit you when you're in the lower bracket or you sell the house. So that is something to consider. Now I wanted to talk to you about depreciation a little bit because although you get to deduct the depreciation every year, you also have to recuperate that when you do sell. So it's not a free ride per se. So every year, once you start, you put it in service, you figure out how much the land is, separate that cost, and then take the difference, divided by 27 and a half years, you get to deduct that amount every year. So deduction for depreciation. However, when you do sell the house, then you have to recuperate that depreciation that you've been taking all these years. So that's going to take into effect once you sell. So you definitely, if you do your own taxes, and now perhaps you're dabbling into like rental properties and stuff, this might be one of those times where it might make sense for you to seek the advice of a certified public accountant or an enrolled agent, because things are getting somewhat complicated. You want to make sure you're keeping track of proper things, that you start taking the right amount of depreciation, not too much, not too little, and that you keep proper records so that when you do sell, you have all the information you need to figure out if you have any profit, any losses that you need to recoup and stuff like that. So very important to keep track of those things. Now, another question I often get too, this might not be that common in a lot of places, but like I'm from New York. In the Bronx, it's very common to have 2 family units, where like somebody will buy a house, it's 2 families, and the person would live in one unit and then maybe rent out the other unit. Very common. So what happens then? And the way that works is the IRS looks at it as if you own 2 separate properties on paper just for tax purposes. So on one end, the portion, let's assume that they're equal units in size, square footage and everything, just to keep this simple. You would take the mortgage interest. So all these deductions are listed before: mortgage interest, property taxes, et cetera. And now you have to split them according to what portion is allocated for rental versus your primary residence. So if you itemize your deductions, where you write off your mortgage interest, property taxes, any other things like that, you would take the portion that is allocated towards your primary and put that as an itemized deduction on your Schedule A. So let's say it's 50%, just to give you an example, and you had $10,000 of mortgage interest, you would take $5,000 of that, put it as an itemized deduction. The other $5,000 goes on your Schedule E as a rental, as you list your rental income and expenses. So in other words, you cannot write off the entire mortgage interest on the rental if you happen to live in one of those units. You might be able to if you itemize your deductions, but still you have to separate them and put one side on Schedule A, which has your personal itemized deductions, the other side on Schedule E, which is the rental property. So you need to keep that in mind as well. And then same thing goes for depreciation. You might only be able to depreciate 1/2 because you're not going to be able to take the full amount of the dwelling and depreciate it, since you are occupying half of the residence. So this is yet another scenario where you might need to talk to a professional, because it gets a little bit more complicated. But it is very common. Once you set it up right, then all you have to do is just keep track of your expenses, all your receipts, your rental income, and so on. If you use a professional to manage your property, sometimes I have clients that have properties in other states that they do not live in. Very likely what the way the company does it is they are in charge of screening the prospective tenants for you. They place the tenants, run a background check, credit report, whatever it is that you decide to do with them. And then eventually they keep track of all repairs and things like that. And they give you a printout at the end of the year, including a 1099 tax form showing how much rental income you had, and then an accompanying statement with all the breakdown of the expenses, repairs, et cetera. And that is very useful for you to then go ahead and do your taxes, because then you can easily just take those numbers and plug them into your Schedule E and easily keep track of what your expenses and your income were. So that's pretty much rental properties and taxation in a nutshell. There are things that you can deduct. There are things that you might be able to take advantage of the year of, like if you have a loss and you actively participated in the property and you made under the income limits. If you don't, then that loss gets carried forward to future years. And if you have a loss on paper and you make too much, then it gets carried over, but you also didn't have to pay income taxes on the income because you actually had a loss on paper. So there's a lot of ways to go about it. And I think, years like this year with the pandemic also provide for some planning opportunities because a lot of people had rental properties and they weren't collecting rent. So they had maybe an even bigger loss, or some people were able to take advantage of losses for the very first time because their own income went down and they fell within those guidelines, So definitely opportunities there, but I just wanted to kind of just give you a very high view of how these things work. As always, if you ever have any questions, feel free to reach out. Also, check out in the show notes, I have a link to On My Way to Wealth, where I have other podcast episodes on mywaytowealth.com. Also, check out the LatinXmovement.com for my LatinXcellence initiative that I'm working on to help close the wealth gap in the LatinX community, Latinos, Latinas. So thank you all, as always, for listening, and I'll see you in the next episode. Thank you for listening to On My Way to Wealth. If you have any questions, please send me an email at luis@onmywaytowealth.com. The information provided here is for information and education purposes only. The opinions expressed herein are solely those of myself, unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by my firm or myself about other parties' information or accuracy or completeness. All information or ideas provided should be discussed in detail with a financial advisor, accountant, or legal counsel prior to implementation. Thank you.